Hi, I'm Mark Rossano, founder and CEO of C6 Capital Holdings, coming to you from Prime Vision Network. Today in the Economy Show, we're going to go through what's happening with global manufacturing, what's happening with the PMIs, and the impacts that we're starting to see with the Indian spread of COVID, and how is that impacting Southeast Asia, because we continue to see this inflation throughout the whole supply chain, which we'll try to break out into different pieces and look at it in through a different lens to try to highlight the problems. So Europe has officially hit into a double dip recession. We'll talk about what does that mean, what happens going forward. And then in the last segment, we're going to look at India and China specifically, because Chinese credit impulses, as we've talked about, I did a whole thread on Twitter, trying to really highlight just what the pressure is really going to look like. And then on the Indian side, with what some of the stimulus that they're trying to do to get things moving through the system. So with that being said, I'd like to remind you, please like, share, subscribe. Your support is appreciated. So before we get into U.S. stimulus, we just want to look at some of the case deaths. So case count is obviously important. We talked about it in the EIA show. It's something to watch. It's something that makes nice headlines. It has big numbers. The bigger issue has always been and will remain infrastructure. And infrastructure can be measured by hospitals and deaths. So what's happening in the ICU, what's happening in the hospital, what's happening at the death side. And this is where we continue to see this shift up in total death rate as we look at from the highs of the end of January, February, and where we sit right now. And you can see the extent in India, which if you think about case count being the leader, then ICU, and then death, they're still at the very front end of what these deaths could look like, which is really unfortunate. I mean, if you think about just the loss of human life. The percentages still remain small in comparison with you think about the amount of people. So that is a net positive. It's not that a new strain has come out that is more deadly. It's just that there is a lot of people. There is a very limited amount of availability of hospitals, and that's why Latin America, India are going to be ones to watch, which again have taken the place of the U.S. and other parts of North America. So this is going to be the one to kind of keeps a watch on as to what could happen with future limitations on movement, other types of restrictions. And how have companies handled that? Well, it's a lot of stimulus. So let's go to what has the U.S. done. So we just heard again with the family's plan of $1.8 trillion. So when you just look at it, if you just consider about the amount of money that's being dumped into the system, we have more money coming down the pike, which is one of the reasons why we continue to see pressure in the market. And we have two different slides on just margin debt, because when you think about the things that are being done on margin, as we have a little over $4.4 trillion or $4.1 trillion coming into the market. So when we look at the family plan, the tax credit, expansion of the child earned income, the IRS collected in revenue, but the tax credits is one side, but the child and family support is going to be some of the bigger ones when you look at paid family and medical leave, child care. And then when we talk to education, the free universal preschool, and then college and universities serving minority groups, and 2-year free community college. So free is a term that likes to get thrown around, but it's not free. It's paid with tax dollars and or borrowing. So these are the new level of numbers coming in. So we've already had obviously the stimulus plans, the beginning of the year, end of last year. But then we have the infrastructure plan, and now this. So how much stimulus can we possibly dump into the market, and what is the residual? And when we go through the GDP numbers, we're going to talk about it. In Q1, we've put $2.3 trillion into the market in terms of just transfers, and it generated $558 billion of GDP growth. Just think about that number and the sheer size of it when we're considering, okay, well, what is it actually generating? How many billions of dollars does it take to buy one GDP point? And that's when we start factoring in law of diminishing returns and these other, so we keep throwing money at it, but eventually you just need to let the market heal itself, let the invisible hand take over, and not try to stimulate, because 46.5% of current fiscal spending is coming from tax receipts and the rest is coming from borrowings. Like this is where we remain concerned about yields and rates and what this looks like, because we are saturating the market right now and we're papering the town at the worst time possible, where let's let the previous stimulus work through the system. We keep instead just layering more and more on. So then when we consider about the different backdrops, so the 1.8 trillion in proposed spending and tax credits covers a 10-year period. So the idea is that this would be spanned out, because only so many people are going to go into different levels, which is why the argument is that a peak amount of this will really be recognized in 22 and 23. So the idea is that you provide a boost through this instead of just providing these huge drops. This one would be a residual that carries through some of the momentum, which has some value behind it, but it's just going to be a matter of what size should it be. Nearly 85% of outlays and credits address these quotes are coming from Bloomberg. Credits address early learning, access to higher education, and families with children. The augmented child tax credit extension through 2025, worth over $100 billion, would be politically unpopular to reverse. So there's some of these that, again, how do you tell families you can't have the child tax credit? Boosting the cost of the plan by over $600 billion over the next decade if it extended by a future Congress. Now, that's where we, because everyone likes to measure things in 10-year increments, which, should not be the case in general. But according to the Joint Committee on Taxation, the elasticity of capital gains are approximately negative 0.79, meaning that for every 10% increase in capital gains tax rates collected, revenue would shrink by 7.9%. When the capital gains tax was raised to 28% from 20% in 1987, realized capital gains fell by 50%. The latest government data shows that in 2018, the top 1% income earners paid 40% of income taxes. Raising the wealthy earners' ordinary income tax rate could make a noticeable contribution to federal tax revenue, just to think about how we do this. But now, taking all of this into consideration and looking into what's happening with the vaccines, where are we progressing on this reopening? The problem is the vaccinations have peaked, because anybody who wanted a vaccine was waiting online. They were first to get it. You had lines out the door. We've now surpassed that. Now we're actually on the other side, where people may not have the time or don't feel the need or don't think it's necessary, or are going to wait and see. And that's where we're starting to, where you can see kind of what the U.S. total is doing. And this just gives a snippet of some very specific states and how you've had a very marked shift lower. And we're going to continue to see that residual move through the system as we get these additional declines. But when we look at the rich tens, rich country versus poor country, when just looking at what is happening with stimulus, where is it going? How, we know that rich countries have more of the vaccinations. How is that going to impact things going forward? So this is a Deutsche Bank share of population in middle income households and annual median income. So this is looking at median income versus middle income share percentage. And the US, when you just take the average, so we have the highest level of median income USD per year when you look at that income level. But US is at the same level as China, Turkey, and Russia when you consider on a flat line across not the y-axis, but the x-axis. So the middle income share has fallen and continues to fall, even though we have some of the highest income in the world. Who do you blame for this? Where is this cause coming from? Could it be trillions of dollars being pumped into the system from the now the fiscal government, but the fiscal side, but really the monetary side? We've been stimulating the economy through central bank usage and monetary policy since 2008. This is the outcome. We're seeing the outcome now. People are wealthier than most places in the world, but yet can't even crack into the middle income percentage because costs continue to go up and they continue to move up exponentially. And this is the one that we keep highlighting, keep beating to death in terms of social immobility and inequality, where you're technically wealthier than most, but still poor within your country or not as wealthy within your country in comparison. And this is always going to lead to a bigger and bigger problem, which we continue to see in the system. Now, take this into the consumers around the world. Consumers around the world are feeling good, and how much of this will adjust, because this is a bit of an older article with some of the spreads that have happened in Southeast Asia. But again, there's a lot of the places that buy stuff are feeling better in terms of Europe, in terms of US, in terms of developed world. And we've seen that in terms of imports, which have remained elevated and continue to shift higher, which is a net positive when you're considering about where do we go from here on the consumer side. The problem is when you break that out into its aggregates of high income, middle income, low income, there's still that disconnect between who feels stronger. Now, the lower income is feeling better. That's probably the biggest rate of change increase, but it's still well below where we should be or where we would hope to be, especially after all of this stimulus has been pushed into the market. And the reason why is the difference between nominal GDP and payroll. And this is just looking at the US, which has been essentially replicated most everywhere, where nominal GDP is up and it's now positive, but payrolls just aren't closing that gap. Now they're getting better. ADP came out, it was a positive number, but it missed estimates again. And we keep missing estimates. And there's that mixture of, is it because we're giving too much benefits where people don't want to go back to work? There's this friction point as to what happens next. And this is where we've been saying that we were going to get that check mark, and then we were going to flatline. And that flatline, we were going to get a rate of change higher. We're always going to progress positive, or at least for now, as far as I can predict, that it's going to be positive. We're going to see job additions. We're going to see jobless claims continuing to go down. It will be in a positive trajectory. The question is going to be the rate of change of that growth, and it still remains at the depressed level. With that being said, the percent of margin debt, everybody is levered long and getting longer, and they're doing it with margin. And this is why when things fall, the fall will be very aggressive. The question is always going to be timing. Could this run for another year? Sure. Could this run for another 2 years? Why not? The question is always going to be, when does it end? And if people like to say, oh, I called the housing bubble in 2005. Well, you went bankrupt waiting for it. So it's all going to be a matter of timing, positioning. But this is some of those charts that remain scary as people remain grossly levered long, and mostly within the S&P 500 at this point. Now, when we go abroad and think about, okay, consumers are coming back a bit, people are feeling a little bit better. Well, let's look at manufacturing PMI. Now, manufacturing PMI has gotten stronger across the board, especially Taiwan, Italy, US. Germany remains strong as well. We've seen some of this pull back, but it still remains well above 60 in some cases, or well above 50 in most cases. And the question is always, what is making up that manufacturing number? Now, I'm just going to break it down slightly. It's not to take away from the fact that we're in an expansionary period, because we are. It's what is causing the expansion at these levels. And it's price increases. So you have prices received, prices paid, and delivery times, as well as inventories, which, depending on the level that they're at, isn't positive or negative. And those, in this case, are all in a positive direction, pulling this number higher, but have a negative impact as to what does it mean for the underlying consumer and the viability of the business underlying it. And that's why some of this, we expect to see some of it normalize, some of it start to come down a bit as we see the normalization along the chain, with some slowdowns accelerating, especially Germany, India, and other parts of the U.S., which we'll talk about in a minute, have seen some slowdown. Still elevated, still growing, but at a reduced rate, with more pressure coming on the back end. Now let's look at it as just an aggregate. So when we take the PMI output index, you can see that we still remain fairly strong. But global manufacturing production, output index, it's all moving in a positive direction, which is why we like to talk about what are Chinese credit impulses doing? Who matters more when we're considering some of these levels for what comes next? And this is the issue with the overheating, inflation, because a lot of these things that are driving the manufacturing index higher are actually inflationary. And then how does that residual move through the system and cause a growing problem throughout? Which is why we want to look at, okay, ISM new orders. And this is coming from Pictet Asset Management, because I think it's a great. He's been very much spot on. This gentleman is Julian, who I recommend following on Twitter. He's looking at this and saying, let's go back to the 80s. This is so far married pretty closely to what happened with that big drop in 80, and then that kind of that double dip that happened in 81. Speaking back to the 1.8 trillion coming in, which I think people are, or at least those in Congress and the president's administration are looking at this, and I think want to find a way to avoid it. And that's what some of this acceleration is for, to give some of that boost when we're supposed to be rolling over. The problem is new orders are already starting to roll over, and we're starting to see some of those pressures come through, because now the new orders are still expansionary as they were here. It's just they're slowing, and they're slowing more because there's a huge backlog. So people are accepting less orders. They're waiting for their backlog because of this residual when we're looking at the issues that remain within the supply chain, which we'll talk about in another segment. Now, the wage growth, and this is what we keep talking about with wages and salaries, we're just not seeing the wage growth. We're not seeing this movement up where, firms saying finding labor is the biggest problem. Companies are complaining they can't find workers, but we're also not seeing wages and salaries go up, because so you can't hire, but you're not paying more. And this is this bifurcation that we continue to see, where inflation is going in one direction, but wage inflation and salaries just aren't following suit. And that's where we're going to have to start to see some of that collapse, which will put margin pressure on companies, because what is the most expensive part of a company is bricks and mortar, or your underlying office, and then labor. And that's where we continue to see some of these pressures coming through the system. And there's just that's why again, the wages become the biggest issue for us in general. And that comes to who's going to spend, which is why when we look at the breakdowns, those who aren't as wealthy are going to struggle. Now, this is we pivot into commodities, and we just want to look at the world's key maritime choke points. So these are choke points that we've talked about and remain a key focal point, especially the Strait of Malacca when we're looking at China in general, and then when we consider some of these other passages in terms of the secondary choke points between South Korea and Japan, and what is going to happen within some of these other regions. But the ones that for crude's component as well as from grains component is always going to be Strait of Malacca and the Suez Canal and the Strait of Hormuz, and all of these essentially areas looking around the Middle East. These are points of constriction, which we saw what happened with the Suez Canal, which is why it takes a long time to have the supply chain catch up. It's every time we start to get close, something else happens that creates a residual problem in the system that, again, puts this weight that just isn't really coming back and normalizing in any meaningful way. And what is that causing? Well, we're seeing commodities continue to trend higher. So this is a chart that's looking at commodities nearing the strongest reaction on record global growth, but we also have supply disruptions. There are some things that are 100% tight on a supply side, and then other things that aren't tight on a supply side that are still responding in an aggressive manner. And you can see here for 2020 so far, we're well through. And then when we look at what the commodity index is doing, we're at a high that we haven't seen since 2011, already pushing this all the way through. And commodities continuing to rally now with over 50% of OECD economies in growth mode, strengthened commodities starting to resemble paths seen in early 1970s, 1998, 2003, and 2009. Some of those are good years. Some of those led to some problem years. taking this to a different level, percentage of commodities up 50% or more, you can see that we're back to levels that we haven't seen since the early 70s. And just in terms of the shortfalls, and I was having this conversation earlier, it's not that we're going to see a huge drop. It's just we're going to go sideways from here. Seeing additional increases is going to be tough. We're kind of here. You're going to have consumers that are going to start restricting buying. They're going to change consumption patterns. But this is going to become a much bigger problem overall as companies continue to try to push through some of these products. As corn exports just are off to the races and remain very, very strong overall, with little to stop it. When you look at what has happened in general in Brazil and Latin America, droughts continue to just crush plantings, yields, crop progress, which is just going to keep the U.S. corn exports moving off the coast. And that's speaking to the issues within the areas. So not only are the drought problems creating growing issues, it's also limiting the amount they can actually move product because the waterways are getting lower and lower, which means that barges that can't be as full. It takes more time. This is that residual that is kind of that knock-on effect that I think is sometimes I don't want to say ignored, but not appreciated when we're considering overall impacts to supply chain. And again, when we talked about the issues overall, transatlantic container rates jumped last week as ship capacity continues to dry up. And that's in the EIA show, we talked about this. There is not a price that some companies can pay to buy their way onto a boat because there's just physically not enough capacity to do so. And that is resulting in this big spike in rates that is not going away anytime soon. Looking at this in terms of the order book for container ships, when you look at the sales in general, the sales have gone up because when you get the shortfall, you go out and try to build more. So this is where we're seeing, but this takes time. There's problems with this. But again, we've seen the residual is going to remain in the system. The supply chain, this is not a transitory thing where it just all of a sudden gets better. This is going to be a residual that's going to last through not only just the rest of 2021, but well into 2022, causing a lot of these shortfalls in general as we go through the rest of the year, impacting inflation, keeping inflation elevated, and impacting the underlying consumer as prices continue to go up and wages just don't keep pace. Eating into savings and eating into just the general buying patterns and wealth that is available for the underlying consumer.